September the 15th marks the 10th anniversary of the collapse of Lehman Brothers. It was the fourth largest US investment bank at that time, and its demise is considered one of the defining moments of the 2008 financial crash. The US economy has since staged one of the longest sustained recoveries in its history. But as William Denslow reports, the crisis has left its mark on much of the population.
If he thinks that the argument being made is stronger than his.
Election season is in full swing. But for Reshma Patel, working in politics wasn't always on the cards. She had worked on Wall Street, first at Bear Stearns, and then she took a job at Lehman Brothers in February 2008. A few weeks later, Bear Stearns went under. Then, in September, Lehman suffered a similar fate.
That weekend, it was a Sunday, I was actually at a friend's daughter's birthday party, and there were people who were there at the party who are at hedge funds, and they're like, oh, you know, we're all trading against Lehman, so it's gonna go under tomorrow, right? And my boss also, you know, and I were actually going into the office anyway to do work, and I talked to her, and so we were like, you know what, let's just clean out our offices.
After Lehman went bankrupt, Reshma got a job at Barclays before eventually leaving the industry. She says the financial crisis gave her fresh perspective.
Power is held in the hands of a few, right? So because not everyone has a financial literacy, some people are able to take advantage of them, make a lot of money, and then control the political power.
But the fall of Lehman had a big impact on the financially literate too. After Lehman Brothers folded, the stock market suffered its worst losses since the terror attacks on 9/11. Some saw their life savings wiped out, and close to 10 million Americans lost their homes. Delmonico's is located just a few blocks away from the New York Stock Exchange. Its managers say its dining options had to change after the fall of Lehman's.
We created a much less expensive dining alternative for them. So we introduced a new grill menu in our bar area as well as the adjoining lounge. And people were able to still dine with us, but at a much lower price point.
After a lean few years, those here say business is now booming. The US economy just logged its best quarter of economic growth in 4 years. But some economists and analysts believe large chunks of the population aren't getting a taste of this growth.
For the most part, the history of the last 10 years since this crisis has been the replacing of higher wage, high-hour jobs by low-wage, low-hour jobs.
The US is currently in the longest bull market in its history. President Donald Trump says the economy has never been stronger, but economists fear the lessons from 2008 have yet to be learned. William Denslow, TRT World, New York.
So what have we learned since 2008? To help us answer that, I'm joined by our guests. In New York is Harold James. He's a professor of history at Princeton University, specialising in economics. And joining us from Paris is TRT World's editor-at-large, Craig Capitas. Welcome to you both, gentlemen. Harold, I'd like to start with you, if I may. Going back to 2008, a day after Lehman collapsed, you wrote an editorial, an op-ed piece in the Financial Times, and allow me to quote a little bit of that back to you, if I may. You said, today there are real risks, on the one hand, of inadequate action, and on the other, of actions that have damaging long-term side effects. Weighing those risks is a judgment call on which history does not provide any firm lessons. Of course, since then, we've had $4.5 trillion worth of quantitative easing. We've had interest rates slashed to zero. With the benefit of hindsight, do you think the Fed and the government got that balance that you spoke about right?
I think the Fed did get the balance right. It really learned the lessons of the Great Depression. The chair at the time, Ben Bernanke, is a great student of the Great Depression. But I think it's also clear that the measures used, the quantitative easing, the low interest rate policy, have distinct side effects, and we're living with those side effects. So it's really like treating a serious illness. Any medication that you give with a serious illness has its side effects, and the side effect of the quantitative easing has been a tremendous asset boom throughout the world, and the emergence of new kinds of potential bubbles, and they pose in the future, I think, a threat.
So at that time, were there any other alternatives?
I think people will debate for a long time whether it was right to let Lehman collapse, because, you pointed out in the introductory segment, it was a large bank, the fourth largest bank, but it wasn't that large. It wasn't absolutely essential to the US economy in the way that, say, in many of the European countries, they have large banks that are bigger than even the GDP of the country. But the consequence of letting it slide was that there was then the problem with AIG, and that was the really serious problem that just sparked a financial meltdown that I think hadn't been properly anticipated before, because before people saw it in terms of the subprime crisis, afterwards they saw it in terms of the large-scale financial meltdown.
Over the last week, I've heard this said a few times, history doesn't repeat, it rhymes. What are the, where do you see the next big crisis coming from?
Well, the most obvious threat, and it's one that people are very conscious of, is the way in which the rest of the world will react to the exit from the extraordinary monetary measures in the United States and the normalization of US monetary policy. As you pointed out, we're in a boom phase at the moment. There are labor market pressures. We expect interest rate rises, but that's going to affect many corporations throughout the world, many emerging markets that have borrowed in dollars, and their borrowing costs are going to rise, and we have the potential there for a different sort of crisis, really a return to something like the 1990s.
And we are seeing some of that manifesting itself in the emerging markets as we speak almost. Craig, I'd like to turn to you, if I may. You've written extensively about all of this. What are your recollections of that time?
Well, my first recollection is the financial meltdown was forecast. It had been forecast for 4 years prior to 2008, every year at the World Economic Forum in Davos, Switzerland. I know, I was there, I wrote those stories. The financial Solons of the world didn't listen. 1 week before Lehman went under, we had a notion at Bloomberg that this was going to happen. And I was dispatched to a yacht called the Caldera, which is named after the volcanic eruption that Plato said sunk Atlantis in the Aegean Sea. I was on board with a number of bankers, including a managing director of Lehman by the name of Nicholas Lazarus. Actually, he had left the company a few months prior. When during this entire week, Lazarus and the bankers who were shuttling back and forth from this boat, as a witness to history, I can tell you, he made over 100 phone calls, some of them as long as 4 or 5 hours. There were hundreds and hundreds of texts and BlackBerry messages. Bankers were being shuttled back and forth. And what I saw happening there was, and chronicled in this story, was a brutal unveiling of the avarice and woe by powerful people who lied about creating value in order to destroy it and enrich themselves. Yeah. And I will give you one of the quotes from that boat. This is from Nicholas Lazarus. This is happening while Lehman is posting $3.9 billion third quarter loss on a $5.6 billion write-down. This is his quote: "Greed trumped everything at Lehman and on Wall Street. They are willing to make a loan to an orangutan."
Right. That is absolutely fascinating. Gentlemen, don't go away. We will come back to you in a second, because The financial crisis began in the US, but its impact was felt around the world. And as Mobin Nasser reports now, many are still trying to recover.
Garðabær is a quiet little town on the western coast of Iceland. It's thousands of kilometers away from Wall Street, but not far enough to shield its residents from the fallout of the financial crisis of 2008. The Olafssons bought a new house here back in 2007. The cost of borrowing was low at the time, so they thought it was the right time to become homeowners. But the quest for their dream home turned into a nightmare when interest rates began shooting up.
When the banks collapsed, the exchange rate more than doubled. So the amount the bank now wanted to collect was more than double what we had borrowed.
It happened because many of Iceland's banks had invested in the same problem loans in the US market that took down Lehman Brothers. Mounting losses forced the banks to raise rates, and that left thousands of Icelanders unable to repay their loans. By October 2008, the government had taken control of some of the country's biggest banks. In the UK, the central bank began pumping nearly $400 billion into financial institutions to keep them afloat, and many other countries followed suit. The total cost of bailouts, penalties, and lost productivity has towered beyond $21 trillion over the past decade. Global debt has mushroomed to $247 trillion as governments keep spending to boost their economies. And there are widespread psychological and social changes like rising distrust among people and the emergence of divisive politics. Some economists fear that's a toxic mix for another recession, and they say it's critically important to protect the most vulnerable.
We can begin by not turning a blind eye to the sentiments of the people we left behind. We must listen to what people have to say. The many people who fell through the cracks of society who were inadequately protected by the system.
But a decade later, people like the Olafssons are still struggling to pay off their crippling debt.
When you look at these 10 years, this is lost time. This is time that we have not been able to make any progress in our lives. We have not been able to plan for the future. We have not been able to go on vacations and make financial plans. And the biggest sacrifice is basically things we could have done with our sons, which we haven't done.
For them and for many others, the cost of the crisis goes far beyond numbers. Mobin Nasser, TRT World.
And Princeton's Professor Harold James and TRT World's editor-at-large Craig Peters are both still with us. Professor James, I want to just show you both a chart showing what the IMF predicts the government debt to GDP ratio of the top 20 economies is like, how it's going to change over the next 5 years, according to them. And interestingly, the only one whose debt to GDP ratio that's expected to rise is that of the US. Everywhere else, that ratio is falling. Should the rest of the world be worried about that trajectory of the US?
Yes, obviously it should be worried. The world monetary system since the Second World War has basically been built around the US dollar. And one of the consequences of the crisis, not just of the last year or so, one of the consequences of the crisis has been that people ask themselves, isn't there a better monetary order that doesn't depend so much on the debt instruments of one country? So the US and the question of how much debt from the US government the world can tolerate is an actual one. Having said that, I think you really have the issue that the United States looks uniquely stable for a long period of time. And even at the moment, with all the political turmoil, the long-term future of the United States is, I think, pretty assured. And so this question of the US being a safe haven will be there for a long time, even if the debt ratio rises.
So to ask the question that you posed, is there an alternative to the system that the US has created?
I think there is. Historically, we've seen the transition. In the 19th century, the world was really built around the British currency, the pound sterling, and it's in the 20th century that the US dollar replaced sterling. In the 21st century, I think you can expect in the long run other currencies to emerge. The renminbi, I think in the long run will be a major part of the world economy. And the Europeans are actively talking about promoting the euro as an international currency. Just a couple of days ago, the President of the European Commission, Jean-Claude Juncker, made that very much part of his State of the Union speech, that the United States is in turmoil and the world needs something else.
Okay. Craig, very quickly, back in 2008, did you get the feeling that this would reverberate well beyond the US's shores?
I'll tell you what I reported from the yacht Caldera while the pomegranate martinis were being stirred, not shaken. While this crisis was happening, the bankers I was with were not concerned about fixing the crisis, repairing the crisis. They were looking to find ways to make money out of profiting from the biggest global financial disaster since the Great Depression. Can we scoop up cheap assets? There was zero concern during that week among the dozens of bankers whom I interviewed about fixing the mortgage crisis, about making people whole.
You're right. Okay.
It led to my favorite quote from Bertolt Brecht's Three-Penny Opera: "Eats first, morals after."
And Professor James, very quickly before we have to wrap up, China. I know it's a huge question, but with $40 trillion of debt, could China be the source of the next crisis?
I don't think anybody is unconcerned about the build-up of debt in China, but I think also it's not the immediate focus of concern at the moment. In the long run, obviously the question of how China handles its rise to being a mature economy is going to be a big issue, but I don't see that really as a pressing concern for the next immediate future.
Okay, we are going to have to leave it there, I'm afraid. Professor Harold James of Princeton and Craig Peters, thank you both very much indeed.